You don't want to miss this episode. We're going to dig into probate fees in Canada, what probate is, what it costs, and how you can plan around it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina. Christina, how you doing?
Hey, Darren, I'm doing good. Excited for another educational episode. I think this is an important one people may not know about.
Yeah, I think, we are in the life insurance business, so we deal with death all the time. And I think this is one that really sometimes surprises families and catches them off guard. So if we kind of talk big picture in Canada, we don't have a formal death tax, but don't let that fool you. You'll pay lots of taxes at death, but we don't have a formal death tax, but we do have taxes triggered at death. Okay, so typically, if one spouse dies, it transfers tax-free to the other spouse. But then we have deemed disposition at death, and that's a big deal. But we also have, and we're going to get into today, probate fees. And probate fees are different than those other taxes I referred to, and it's going to vary greatly across the provinces. So these are provincially or registered or provincially enforced fees, not federally. And they can be really, really significant in some provinces and not so significant in others. But we're going to dig into why it's important to plan around it, because it's not just about the fees. There's a lot of other things that can really, really affect how your family deals with the death in the family. So quick note before we start, we are not lawyers. We're not tax accountants. This is educational advice only. It's not legal or tax advice. Probate planning can be incredibly effective, or it can backfire. So it's got to be done correctly, not casually. So always make sure you're coordinating with your with your estate lawyer and your accountant.
Yes, great advice. And
good disclaimer.
Yes, very good disclaimer. I like that. And before we jump into it, I am going to remind everybody, if you're listening on your favorite podcast platform, please make sure you like and leave that or subscribe and leave that 5-star review for us. If you're listening or watching on YouTube, please like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right, let's dig in. Christina, where do you want to start?
Okay, so why don't we start with what is probate?
That's a great.
Yes, it's a great place. So before we define probate, I do want to separate probate from those taxes that you mentioned earlier. So the two are different, but people often mix the two together. So in Canada, when someone passes away, CRA applies something called a deemed disposition. So it's like everything you owned was sold that day. Now it's treated as if it was sold at fair market value, at the value of your death, and it can trigger. So that's where you're going to see capital gains taxes that have to be paid on investments, properties, things like that. Income tax on registered accounts like RRSPs and RIFs. So it's like you just cashed out that RRSP that day. That can be highly taxable. Now, as you mentioned, if you do pass it to a surviving spouse, you are going to have a spousal rollover. So you're not going to experience the tax that day. But remember, it is a deferral of the tax. It hasn't gotten rid of the tax. You've just deferred it to the second spouse's death. And that's when you're going to see that major tax hit. So when the second spouse dies, there's no rollover left. Capital gains are triggered. Registered accounts become taxable and CRA gets paid. Now, that needs to be planned for, absolutely. But it's not what we're talking about today. So that's your deemed disposition tax that you want to plan for as well, because if you don't plan for it, CRA will have a plan for you. Now, probate. What is probate? Well, probate is the court process that confirms the will is valid in many provinces, and the executor has the legal authority to deal with the estate assets. So this is a fee that has to get paid in order to start processing the estate and going through the will. So think of probate almost as the system that gives the banks, the land titles, the offices, investment companies comfort knowing that they're releasing the assets to the right people. So you got to pay that fee for them to deem that these are where these assets should go. Probate fees aren't a federal tax. They're not a tax. They're provincial court or estate administration fees, usually based on the value of the assets that flow through the estate. So for someone with a high value estate, this is going to be important for planning, because this is where you get hit with the probate fees. Now, what typically flows through probate, triggers those probate fees, are anything that hits the estate. So if it goes through your estate in your will, it is going to trigger probate fees. So things that are in the deceased soul name. So a bank account, if it's just in your name, it's going to hit probate. Non-registered investments, real estate, your family home. If it's just, a lot of people, you've got a primary residence exemption, don't have that on the probate side of things. If it's going through the estate, you're going to have that. Anything that's in their name, so some private company shares, depending on the structure, and anything without a beneficiary designation or right of survivorship. So this one's important because we are going to talk about some things that we can do. But if you have a beneficiary designation that says estate, it is going through probate. So that's very important to note. Now, what often bypasses probate are RSPs and RIFs, tax-free savings accounts with a named beneficiary or successor spouse. So if you've named the beneficiary on there, you are okay. Now, you're still going to have the tax to pay on the other side. So keep that in mind, but you're going to avoid you can bypass the probate. Assets held jointly with right of survivorship. We're going to cover this a bit more because it is important that this is done correctly, and I have seen it cause many a mess. Many messes when you do it incorrectly and you DIY that. Life insurance with a name beneficiary. This one's my favorite. We talk about life insurance on this podcast every day. Life insurance is the only thing that is going to bypass probate and hit your family's hands completely tax-free. So it is a very efficient way to pass down the wealth. So why does probate matter? Well, people often think it's just about the fees. And we're going to talk about the fees because they're different by province, and some of them can absolutely get very high, and fees matter. But honestly, the bigger plan is usually time delays. When stuff has to go through probate, we're talking, I've seen years where it's going through that probate process, and you've got a bank account that your family needs access to and it's stuck in probate. You don't have access to it, right? So you've got delays. Executor workload. If you've got a family member as your executor and they're doing this, I've talked to many of people that have taken on that task as families, and it's a lot of work. It's a lot of work, and processing this is not easy. Lack of privacy. So since probate filings can be made into public record, it's going to be on public record. So anybody can access the records when it's going through probate. And frozen assets will institutions wait for court authority. So that's, like I said, with the frozen bank account. I've seen it many of times where, even a spouse can't access the other spouse's frozen bank account because it's going through the probate, which is crazy.
You think of that, like you leave a substantial amount of wealth and your family has all these bills, but they can't actually access the wealth because it's tied up, like you said, sometimes for a year or two in probate, especially the more complicated estates. Like, it is a big deal that most people don't even think about.
Well, yeah, because especially in some, so we're going to talk about the provinces, and some do have very minor probate fees, absolutely. So you think, probate's not a problem for me. But these other aspects of it do become a problem, like that privacy thing when you've got family members out there looking at things, you've got time delays, other aspects can hurt. Anyone
can go down and get a copy of your will. Like people are always surprised when I say that. It's like, well, yeah, anyone can go down and get a copy of what? People get a copy of my will after I die? It's like, yeah. But yeah, the cost is one thing we're going to talk about, but the time delays, that sometimes, Christine, I don't want to generalize here, but sometimes governments are inefficient.
Sometimes. I don't know. Yeah, there's delays. It's not ideal. So this doesn't come down now, and especially with that second death, right? So first death, you might get off a little bit easier, but the second death, that's when you're going to have that deemed disposition. You're going to have the probate fees. So it's really about, how do I make this easier for my family when they're already dealing with the grief of losing me? So yes, the fees are important, but also making it easier on your family is a very, very important reason why you'd want to look at some probate planning as well.
Okay, cool. So let's kind of get into some of the fees. So we keep talking about these fees. They vary across provinces. So let's give you some actual numbers for various provinces, and then you can decide what province you want to move to pay less fees. No.
Yeah, and keeping in mind, if you're listening to this, these can change in the year each year, but as of today's recording.
So again, the fees do vary widely across Canada. In some fees, it's just a small filing fee. In other province, it's percentage based. So depending upon where you live, this is the fees you're gonna charge. Let's start with Ontario. Ontario calls it the estate administration tax. No fee on the first $50,000. So $50,000 of the estate, no fee on that. And then it goes to $15 per thousand, which is 1.5%. So anything above a net worth of $50,000, you're going to pay 1.5% fee. Again, fairly significant on top of, a months or year of, or potentially more of delays. So, think of that from the family's perspective. Proper planning, they could have got the money quickly with no delays, with no fees, not planned for properly, could be months and months and months delayed without that money and pay 1.5% fee off the top. So again, huge. BC, no fee up front no fee on the first 25,000. Then it goes to $6 per thousand up to 50, and then $14 per thousand over 50. So pretty similar to Ontario. Now Alberta is the place to be for probate fees. So the probate fees in Alberta is capped at $525 only if your estate is over $250,000. So if you get an estate over $250 or $250,000, they're going to charge you $525 as a fee. Saskatchewan's got a pretty low one, $7 per thousand. Manitoba, they eliminated probate fees in 2020. So Manitoba, there's no probate fees. Now, in court filing charges can still apply, still can get the delays, but no fee. Now in Atlantic Canada, we're really good at charging a lot of money for things. New Brunswick's $5 per thousand. Nova Scotia is $16.95 per thousand. So that's about 1.7%. So congratulations if you live in Nova Scotia. Not only do you have the highest marginal tax rate, but you have the highest probate fee. So proper planning is really important in all these provinces, but Nova Scotia, you're going to have a huge impact. PEI is not bad at $4 per thousand. Newfoundland and Labrador is 0.6% per 0.6% fee. So if you're thinking, wow, my province is expensive, well, if you're living in Ontario, BC, or Nova Scotia, yeah, it is. But again, the fifth time, the fee is one thing, the delay, the privacy, the stress on the executor, it's another thing. So even if you're in a low fee province, don't think, I don't need to do anything. You still need to do proper planning, even if you're in a low fee province. But those are the fees kind of across the country.
Yeah. So if we look at the fees, we look at the problems, what are some solutions or planning strategies that we can look at to reduce or maybe avoid probate fees? So I'm going to break it into a couple simple strategies and some advanced strategies. You want to be working with a professional whenever you do any of these things. The first simple strategy is beneficiary designations. This one can be easily done. So use assets that have a beneficiary. Again, my favorite, life insurance, has a named beneficiary. So it passes directly to your beneficiary, tax-free, bypasses probate, check in hand to that individual, right? No privacy issues.
In a week or two.
Oh, in a week or two. Yeah, exactly. You show the death certificate that the form's sent in and that check's coming back. Something to note with this that I see sometimes get missed from time to time is adding a contingent beneficiary when you can. So the way that it would hit probate is if the death benefit goes to your estate. So you name your beneficiary, you're fine there. You name your beneficiary as your spouse and you both were to pass at the same time, well, it defaults for it going to the estate. You can actually name a contingent beneficiary so that if something happened to your first beneficiary at the same time, it's going to go to that contingent. We're not going to hit the estate again. So checking to make sure you have the contingent beneficiary. RRSPs and RIFs, they have a named beneficiary. Again, make sure that's sometimes people think if they name a beneficiary on an RRSP that it's going to eliminate the deemed disposition tax. It is not. It is not. It's going to eliminate the probate, but the estate is still responsible for paying that tax. So whatever the tax was for them to withdraw that RRSP on the day they die, that does need to be paid.
So you avoid the 1 or 1.5% fee, but you still have to pay the 50%
Yes.
tax.
Yeah. And I'll tell you, I have run into people that thought, well, no, I have a beneficiary on there. I'm fine. Nope. If it goes to your spouse, you're okay. But that second death, you're paying tax. TFSAs, you can name a beneficiary on there as well so that it bypasses probate. Now, TFSA is going to go tax-free. One note I like to just encourage people is to name their spouse as the successor owner on a tax-free savings account, because if you do that, when they take over the TFSA, they actually get your room. So if you don't name if you just name someone as a beneficiary, they don't get that room. If you have them as your spouse as your successor owner, you can actually they'll let you keep it inside of a TFSA. So that one's important. Now, those are probably the cleanest, lowest cost probate reduction strategy when it fits to the overall planning. Simple, naming beneficiaries. Just watch out for outdated beneficiaries so you don't set it and forget it with these, life insurance policies, things like that. Don't set it and forget it. Naming minor children without a trustee. That is very important. Don't just put a minor child on there, not name a trustee. That is going to get it tied up in the probate process because there's not going to be somebody that can hold it for them. And watch out for blended family fairness issues. So sometimes you'll see it where maybe the life insurance policy is $100,000 and the RSP is $100,000, and they name a beneficiary for each, thinking that it's going to equal. Like we just talked about, it is not going to be equal. The life insurance beneficiary is going to get $100,000; they're going to get $50,000, right? So that can become problematic if you don't think it through beforehand when you're naming the beneficiary. So something to think of. Next one on here, it gets a little bit more complicated, and one that I say never do it yourself. Do not DIY this one, is joint ownership. So joint ownership can bypass probate, but it can also cause problems. So the things that you need to watch out for here, disputes with other beneficiaries. So if if they were given one thing and somebody else was given the other, you could have a dispute if that the asset that you put in joint ownership is worth more than the others. You immediately have credit exposure to that other individual. So if you put your child on the ownership of your home, their creditors are now exposed to your home, right? So that's something to keep in mind. There's legal issues around gifts versus resulting trust, things like that, where the asset's going to come back, tax is going to need to be paid. One I see people try to do sometimes, and it doesn't make much sense, is doing a joint ownership on your primary residence. You get one primary residence exemption. As of right now, as we're speaking, we have one primary residence. So you don't pay the tax on that deemed disposition on your family home. You add a joint owner on it, it's now, that portion is not going to flow tax-free, right? You're not going to get that boost up in adjusted cost base for it. So it might make sense to avoid the probate, might not, because you're going to pay the tax on deemed, you're not going to get that boost. You're going to pay the tax on the deemed disposition when you do it. So something to carefully calculate before you decide to do that, because one might outweigh the other when it comes to saving the tax and doing the overall planning. And then another one is unintentionally breaking your will. So if you did a joint ownership with someone, but in your will, you said it was supposed to go to somebody else, that's not going to fly. So yes, joint ownership can reduce probate, but I do find that it's not automatically good planning. And people will just think it is immediately. They're like, oh, well, if I join ownership that's going to solve my problem. It's not always going to do that for you. So keep that in mind. The next one, which is more of an advanced strategy and something you absolutely have to do with professional, is multiple wills. So in some provinces, especially Ontario, they will allow multiple wills for certain assets. And this is where you hear the term corporate wills, usually in the province of Ontario. They have things like that you can hold private shares in those wills. It's going to become a corporate will. That's going to avoid probate. Now, this is highly technical. It's province specific. So depending on your province you're in, you might or might not be able to do it. There's not dual wills everywhere, and it must be lawyer drafted. So you writing it down is not going to change it. It has to be lawyer drafted. So keep that in mind, but it can be done for planning. The next one on here is trust planning. So certain trusts, using certain types of trust and structures, can reduce probate and provide continuing your legacy and what you want to happen. So there's alter ego or joint partner trust. So that's where you can actually, while you're still, you can pass that on after the age of 65. There's a rule where you can set it up so that it's not going to go into the estate. It's going to flow through the trust instead. There's other inter vivos trust structures that you can do while you're still living that can avoid it hitting the estate. If you do a testamentary trust, it is hitting the estate when you die. If you set the trust up ahead of time and now there's lots of rules around these trusts before you go do it, but there are ways that you can do it. They can be very powerful, but they come with setup costs, annual tax filings, and ongoing administration. So may not be for everybody depending on what you want to happen with your planning, but absolutely something to look into. And then the last one I have on here is corporate and estate structuring. So if you're a corporate business owner, there are things you can be doing with your corporate structure, with family trusts that can reduce this probate or even eliminate it. So the things that you'll see that are often exposed to probate exposure are private company shares, corporate investment accounts, personally held real estate, things like that. We can do a lot of really cool planning for business owners where we use family trusts. We do share structures that can help help avoid or even eliminate probate in some situations. So if you're a business owner, you're definitely going to want to look into it.
All right, Christina, I love that recap. And again, you don't need to be an expert on this. You need to identify, you need to get advice on this. So I like that. But I just want to bring it home in a real world example. So let's say, when you die and your spouse is already deceased, you've got $1 million in your RSPs and you've got $1 million life insurance death benefit, and you don't have a beneficiary on your RSPs, and you have the estate listed on your life insurance. What's going to happen at death? Well, the $1 million life insurance is going to pay out tax-free, but it'll be tied up in the estate. The $1 million of RSPs you'll pay, depends upon your province, roughly $500,000 in tax. So there's going to be $1.5 million there that you want passed down to your kids or your family. It could be tied up for months or a year or two in probate while it goes through the system. You could be paying fees of anywhere from, low to 1.5% or more. So what do you want to have happen when you die? All you had to do in that situation is a little proper planning. You have a beneficiary on your life insurance contract. Let's say it's 50-50 with the kids, and you have a beneficiary on your RSP. Now you're still going to have $1.5 million. You're not going to incur any fees, and those funds will be transferred in the next couple weeks. That's a significantly different scenario. Which scenario do you want? Do you want the $1.5 million going through fees and being tied up in the courts? Or do you want that money flowing to your family, the people you want to get it in a timely manner? And when you think of it, oftentimes when that second spouse dies, there's a lot of tax that needs to be paid. Maybe they own income properties, maybe they own businesses. So then you get into situations where, some of that money from the RSPs or life insurance can be used to pay that tax. But what if the tax bill is due, but you don't have access to the liquid money? Then you get into, is the business, maybe the business or property, there's going to be a fire sale that you're trying to sell it to get money. We always say what solves a lot of problems in life is a big bag of tax-free cash. So when the second spouse dies, the kids, they're going to have a lot of problems dealing with the death of their parents. It's not going to make everything better, but it's going to make a lot of those problems easy to deal with a big tax-free bag of cash. So yes, you should have life insurance and all those things we talk about, but then don't forget the little simple things like probate planning so the money can get there in a timely fashion, because you worked hard for this money. You don't want it tied up. You don't want the government taking more than they already will. So if we kind of wrap up here, people really think about probate as the fees and something I don't really need to worry about, but it's a really big deal, especially on the timing and on the fees. So the simple kind of checklist is, okay, if we wrap it all up, step number 1, know what your province's probate fees are. Okay, you just should know them. If you don't, Google it. It's not that hard. Number 2, list your assets, everything you own, and how they're owned. Are they owned personally? Are they owned joint? Are they owned? Review every beneficiary designation. So great. On my life insurance, when's the last time I looked at my beneficiary? Do I have a contingent? for my RSPs, for my TFSA, do I have a beneficiary? So check your beneficiaries. For business owners, review your share structure and wills together. Don't plan in isolation. Coordinate with your estate lawyer, your accountant, your insurance advisor if you have insurance in place. If you don't, check out controlandcompound.com. But your goal isn't to just lower probate. It's to make this a smooth, tax-smart transfer that protects your wealth and your business and your assets to get them to your family in a timely manner without all those additional fees. So if you haven't investigated probate, we encourage all of you at least follow this checklist. Identify, maybe you don't have a lot of areas of concern. Maybe you have a couple big areas of concern. Maybe you can solve it with a simple beneficiary designation. You can solve some of your problems. Maybe you need to get that advanced help from accountant and estate lawyers. But regardless, if you're a Canadian, you're going to be exposed to this stuff. You need to understand it. And we always say, no one cares about your money more than you. So you need to invest a little time and effort in that. And it's really not that hard to investigate if you need more help. All right. So that's probate in Canada. Thanks for watching. Thanks for listening. Have an awesome day. Thanks for watching that episode. Don't forget to subscribe to our YouTube channel. Click that like button. Hit that bell button so you never miss an episode. And if you want to learn more about us, go to controlandcompound.com. We'll see you next time.
Thank you for tuning into this episode. The information contained in this podcast is for informational and entertainment purposes only and is separate and apart from the wealth coach services provided by Darren Mitchell and Associates, Inc. to its qualified clients. Control and Compound Financial expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, or any other damages arising out of any individual's use of this podcast or the information in it. The views expressed here are those of each participant and guest and not necessarily those of or endorsed by Control and Compound Financial, its affiliates, subsidiaries, and their respective directors, shareholders, officers, or employees. For full disclosure, visit controlandcompound.com/podcast-media.